Sarah, do I have permission to let people in?
No, because I haven't made you the co-host yet. Sorry. Oh
Okay.
my gosh, where's my
No, that's
mind today? That's crazy. Admit, am I crazy? A little bit. Sometimes I even wonder this. Brad Bob's assistant. Remove. Bye. Nope, not doing this. Sorry, everybody. We're just getting Katie up and running here with checking people into the meeting. Katie, are you all set with this?
I'm good, Sarah. Thanks.
Okay. Hi, everybody. So for those, why do I always say it like that? That's so narcissistic. Like, why do I say for those of you that don't know me, like I'm the president of the United States or something? Oh my gosh. Anyways, hi. So I'm Sarah Grillo, and thank you all for being here. Woohoo! This is the September 2025 Transparent Advisor Meetup. And thank you all for being here. Thank you all for learning. Thank you all for being transparent advisors, by the way. Okay, it's an important thing in the world. So amen to that. Now, just going to start out with some quick announcements. The first thing is that there's captioning that is enabled, okay, at the bottom of the screen. If anybody requires any accommodations for my meetups, please let me know. It's best if you let me know ahead of time because on the fly is a little bit tough, you know what I'm saying, to make those accommodations, but I'll try. Any accommodations, hearing, visual modifications, anything like that. Now, this is a recorded meeting. If you can't be on a recorded meeting, please don't be on this meeting. There's no AI on these meetings. Okay, so please don't send your note taker. I know a lot of people do that. Please don't do it. Here's a new thing. There's going to be total transparency here on these meetups themselves. So you have to put your first and your last name as your name when you're here. If you're just gonna, okay, so for example, Rachel, could you please change Garrett Planning Network to your first and last name? Okay, can you please not transcribe it, John D. Benedetto, por favor? So people need to know who's in our meetup, okay? So if you don't do that, if you don't write your first and your last name, then I'm booting your butt out. As soon as I get done, Katie gets done admitting everybody, she's gonna just boot who's ever butt out if you just write your first name and not your last name, and you're disqualified, okay? You're banned from these meetups. Now, just want to let you know that the immersion is a packed agenda. Holy smoke. I can't even believe, and I do not take credit for this. I give all the credit to this group for this. But holy smoky bokey is all I have to say, folks, is that this immersion agenda is wild. We've got people talking about how to do a flat fee raise. We've got people talking about how to run a lifestyle practice that have done these things before. This is not just hypothetical. It's not like thought leaders, okay? This is actual people. We've got financial coaches coming, financial therapists coming. We've got people talking about mistakes that they made. This is the agenda, folks. You could see what I don't have on the agenda here, folks. I don't have on the agenda insurance presentation. Sorry to anybody, okay, but sorry, I'm not going to be having you be sold things by vendors selling software. No one's going to sell you any insurance. No one's going to be, there's no wholesalers making presentations here, folks, okay? It's because I care about you connecting with each other. Unity is our best ally, is our best asset we have here in the transparency movement. And I want to make sure that there's as much networking as possible. There's all kinds of topics specific to flat fee advice only and hourly planners. If you have not signed up for the immersion yet, please sign up for it right now. And the link is in the chat. If you want to talk with me about it or about anything else, meet with me. Let's set up a conversation. If you have questions about this, yeah. Let's do it. Okay, next. There is a meetup on October 8th. The next meetup is October 8th with Travis Hughes. He's a flat fee advisor. He's going to talk about scaling and growing because guess what? He's a flat fee advisor and he's scaled and grown. Yeah. So the other thing is, so here he is actually. You might recognize Travis. As soon as I find the share button, oh my gosh, there he is. How I scaled and grew my flat fee firm. Go ahead and sign up, please, if you have not already. And the sign up link for the next meetup is in the chat. It's October 8th. Also, there are these little marketing programs that I started. So one of the biggest issues that I find people have, or one of the biggest inhibitions to people striking out and joining this model is, well, how am I going to get new clients? Some of them have been entrepreneurs. Some people just don't know how a business can work this way. I'm not going to make any money. Okay, well, guess what? We think of things in terms of impact here in the transparency movement. And let's look at it this way, that there are so many people that are not working with financial advisors. They're doing it themselves. They could use an advice only or an hourly. There are people that are being turned away because they don't meet the minimums. There are people that are paying $4,000 to their financial advisor at a wirehouse and they don't even know what they're getting for it. So the world is full of opportunity. I believe in these models. I help financial advisors launch and grow these practices all the time. And I started these marketing programs upon request from this group. The pricing is accommodative to this type of a business model, but you have to be a legit person that's pursuing this business model. You just can't say, well, I'm an AUM advisor charging 2% each year to my clients, but I'd like to be on your flat fee marketing program to get like the pricing that, yeah, no. Okay. So everybody, thank you for being here. Please do think of me. I customize these programs to flat fee advice only or hourly advisors. The only programs that are customized to you folks in this whole entire industry. Because, I like y'all. I'm fond of y'all. That's why I do it. Amen. So having said that, I think I'm going to start next introducing today's speaker. And I'd like to introduce, now, let me know if I said your name wrong, okay? I practiced it after our last meeting. Stefan Scheip.
Stefan Scheip. Yep. Not fancy enough for Stefan. So
Okay.
Stefan works.
Stefan Scheip. Okay. And so he is head of an RIA firm with $1 billion of advised assets. Heck yeah, first of all. And second of all, he's extremely knowledgeable. He's a PhD and he's extremely knowledgeable about M&A activity for flat fee, hourly advice only advisors. We've got some great questions that have already been entered into this meetup that he's going to cover. So I'm going to stop talking now. Amen to that. And thanks all for being here.
Perfect. Thank you, Sarah. Good to see everybody. I've been in and out of some of the meetups before, and I think I was on the transparent list way before the meetups came around and been around the space. And that's led to some really interesting conversations with Sarah and I around how succession works. And I've talked to advisors who are friends or colleagues and the difficulties with succession planning valuation in the flat fee space. So the hope today is really to jump into some of how that works and things to think about as you're looking at your firms and structure of the firms and valuations, and hopefully put together some kind of interesting cases as well on what valuation could look like and some of the models that are commonly used out there. So I'm going to share my screen. I got permissions to do that. Here we go. So we'll go through valuation on firms. Give you a little introduction first before we do that. And also, if you have any questions we're going through here, by all means, throw them into the chat. I'll try to check regularly here. Sarah, feel free to stop me if you see stuff coming in on different topics as we're going through it. So background on me. So started off in academia. So I had my dissertation was on conflicts of interest and executive compensation for publicly traded companies. That changed pretty quickly. So I had the experience that many of us have experienced many times, whether for clients or ourselves, where someone tried to pitch me in my early 20s on how great a whole life policy would be for the rest of my future. And it didn't work out too well. But what was interesting about it was I didn't realize how little had to be disclosed for the fee structures on some of these commission products. And it was the same typical tactics that we've seen where it was, well, my clients don't pay me anything. It's free. right? Because I'm going to be able to put together the product for you, and all these things. So my research ended up shifting toward the conflicts of interest of investment advisors. So ended up working on a few papers there. Taught at Florida State, at the University of New Hampshire, did most of my research, and really started to dive further into the space around transparency and conflicts of interest for clients when it came to the advisor space. That led to me opening up a firm. Started off where it was just pure hourly flat fees, where we've remained, where we don't take any assets under management. Right now, as Sarah had mentioned, we've continued to grow, and it's been fantastic. In this space, I think it gets a bad reputation sometimes, or has a reputation of being a space where you can't be successful in an AUM world. But we've been around now for going 7 years or so. We've never taken on AUM. We don't do any management of assets. It's pure advice only. From a firm perspective, we passed $1 billion last year in assets under advisement. We'll likely hit 2 billion this year in advisement. We tend to work with a lot of high net worth and ultra high net worth individuals. So we don't have necessarily minimums associated with anything. Generally, we don't start to show up on people's radar until they get to the $10 million mark for assets that we're dealing with. So the classes I had taught, and what led to the conversation with Sarah, we were talking about what things are missing from this movement. And I've been a big fan of this idea of moving away from an assets under management model and fee structure, especially in a world where so many people are managing their own assets. So we were talking about the lack of succession options, and it gets really difficult to build a category of financial planning or investment advising when there's not a clear exit strategy for people. Right. So when there's no clear exit strategy, it becomes really difficult to spend your career building something, right, and wanting to expand further without there being an exit. And that makes it really difficult. And actually, I think it provides a lot more motivation for people to shift away from flat fee and hourly over to an AUM model, because they see the multiples, they see how easy it would be, and it would be great. You go shift over here, and then you have a good asset path for you and your own personal retirement and everything else. So talking about that, had a great conversation, as Sarah does. She's able to rope me in to come in and talk about some of the things I had taught at New Hampshire and at Wake Forest around structuring business valuation, especially for service type businesses. So how businesses are valued, what tend to be the value drivers. And by nature of the clients you work with, we tend to see a lot of these situations. So a lot of deals end up crossing our desks where we're looking at different models and when things go well and when things don't typically go well in these worlds. So with that, if we look at kind of the agenda for today, we're going to start off with where succession planning is and where the difference is between non-AUM firms and AUM firms. We're going to talk through some different valuation methods and benchmarks. I think that area is going to be nice because we're going to have some, I've got a model I could actually show you. We walk through a little bit there. Key drivers of value, succession strategies, action steps for advisors, and kind of a timeline here, because that ends up being a problem. The best time to start thinking about this is yesterday, regardless of where you are in a firm, because it can structure how you plan for the firm now and also how you plan for the firm in the future. Right? Saying that you want to retire tomorrow and you want to have a succession plan is a very common but horrible idea for many reasons, not only on value, but just on structure as well. So we know that AUM firms are going to have a little bit of an easier time selling. And it's really common. You have plenty of RIA aggregators out there who can pull together a lot of firms. You throw more money in the pot and you charge your 1%. So fees are known. You have a model that is known. It's going to be easier for clients not to see the distinction between them, because the service would still be the same, meaning that they're still having their assets managed just by somebody else. Because of that, they also have very sticky revenue. Right. So in an AUM model, you're going to have assets that are there, and you're not going to go from $100 million in management down to $50 or $50 million in management in a year, unless the market decides to help you out with that, right? But it's not going to be the case, right? So, and the buyers know that. You have these PE firms that come in, these aggregators come in, and they see that opportunity of saying, this is pretty sticky revenue. If we buy it in, then there's reduction of risk to us that we know what the expectation of revenue would be out into the future. And that's the one thing I really want to drive home. If there's anything to drive home today through our conversations, is just that risk is everything in this. And we're all in finance, we know that. But when it comes to purchasing businesses, selling businesses, it's the risk profile that matters. And everyone's just trying to hedge risk. As a seller, you're trying to hedge risk of you getting paid the appropriate amount that you feel that it's worth. And as a buyer, you're trying to make sure that the cash flows that you're buying actually exist and that they're accurate. So the issue there is when we go into the flat fee space or the hourly space, there's not a lot of benchmarks, right? If you go try to pull up what a hourly fee is worth, or an hourly firm is worth, or a flat fee firm is worth, it's very difficult. But fortunately, that means it starts to be treated much like other service type businesses, like law firms, accounting firms, right? Any type of consulting firms that tend to show up in different industries and all have very similar metrics and different structures around deals. Now, because of that, what tends to show up is the lack of recurring revenue. So when we think about what this looks like, it's not just recurring cash flows, right? So for instance, if I'm talking to one of you and you say, I'm looking at my business evaluation and I'm the sole advisor, which I know is the case for many people, and I'm looking at recurring revenue, you may have recurring revenue for you being the advisor over the past 10, 20 years, whatever it's going to be. But now you've got to convince a buyer that when they come in, that same revenue will continue on a recurring basis, right, if you're gone, which is a lot harder to say. And that goes to the last point here, that in many cases, the clients that you have are often buying you, right? There's not a firm there. They're buying your expertise, the relationship that you have with you. And there's not necessarily anything wrong with that, right? This is where the idea of lifestyle practices tend to come in, and there's a great thing, but there tends to be a disconnect there in service businesses where someone says, I have all this revenue that I've generated, and they don't realize what they've generated is a very lucrative job, but they have not actually generated a business, right? They don't have a business to sell. They have a job to sell somebody else. And the reality is, unless you have a internal succession plan where somebody wants that job, your firms that would be buying, your PE firms or your other larger firms that are going to be buying, they already have a job. They're not interested in buying your job, right? They want to be able to have something that ends up being more scalable. So when we talk about that risk from the buyer perspective, so somebody looking at your firm trying to determine, is this going to be a good fit? What are the things they're concerned about? First is client retention. You should start tracking that immediately, right? You should have those numbers rattling off of the top of your head of saying, how many clients stay and how many of them do you think would stay once the owner exits? Which ends up being a common theme from all of this in any type of business valuation, whether it's service or not, is that the value, the multiple that someone will get for a business is significantly higher when the owner is irrelevant, which sounds horrible if you're an owner, right? And you're looking at this and saying, well, my business is valuable if I'm not there. I am the value. And that's not necessarily the case. When someone's trying to buy a business, they want to be able to buy a business and know that it can run as part of their portfolio of businesses, or they can tack it on to current service offerings without having to go step in and actually run the place. So the more disconnected you can have the owner, that's a difficult process, but any means, right, of trying to remove yourself from those paths. But the more you have that removal, you end up with a true business that then can be sold from one owner to a next. So client retention risk tends to be the largest ones because we don't have that sticky revenue that an AUM firm would have. And even if you are managing assets, you probably aren't managing assets for the same cost or the same fee as someone charging 1 or 1.5% of AUM, which means now that 1% AUM firm that's looking at you say, well, I manage assets, so I have $100 million that somebody could buy. You actually run into a situation where they may not want to buy, may not be that appealing, because then they know for them to stay, for them to buy your firm, they now have to buy your firm and convince all of your clients that they need to double or triple their fees, right, to do the same work, which becomes a lot harder. So they don't want to touch it. So we have to be aware of that. And that's why I say thinking about these things earlier on is huge. And fee consistency is another one, right? So flat fee sustainable. We do a lot of project, my firm, right? We do a lot of project fees, right? That's a big deal for us, right, on this, but that's something that's looked at. How sustainable are those flat fees? Do you have a process in place to turn flat fees into a renewable source of revenue for the firm? And then the last two right? The scalability and transferability really have to do with this bolt-on idea that buyers are typically looking for a way that they can take an existing business, they can keep running that business, and they can bolt on a service, right? It may be a CPA firm wanting to purchase your business to bolt it onto their current products, right? It may be a private equity firm who comes in and wants to aggregate your firm with a bunch of other firms together, right? They're looking for a way to scale. It doesn't, again, going back to the job perspective, they don't want to buy a job. They're looking at buying a business. So that's what they're concerned about. The riskiness of those future cash flows is the concern. Now, when we look at AUM firms, benchmarks vary, right? Typically, you're looking at three. Sometimes you hear things of revenue benchmarks at 4 or 5 for traditional AUM 1% type firms. And maybe that's the case. A lot of the times you'll get higher multiples for growth expectations or the types of clients you're working with. Basically, if I'm a PE firm and I'm picking you up and I own all of these different insurance firms as well, and I can buy your firm, then that means I can sell all of your clients' insurance over here, and that may give me less risk, which gives you a higher multiple on your cash flows for what you're dealing with. So we'll see typically around that 3 number for recurring revenue. And the recurring is the key word here, right? It keeps coming up. It's not just 3 on revenue, it's 3 on recurring revenue. This is where you'll see a lot of insurance sales, even in the insurance business, that'll drop as well, depending on how many plans are being sold versus ongoing trails of fees. So the AUM firm, a lot of action in here. There's a lot of liquidity, right? And liquidity ends up being a big one for PE firms. And this was something, I'm going to hop out of here a little bit so we can talk about it, that a lot of people don't see as the private equity side of things. When you're looking at a deal and a private equity firm is looking at buying out a firm, very rarely are they looking at a situation where they're coming in to buy your firm and they want to hold it forever. There's an exit timeline, right? Their investors, their LLPs are expecting a return on investment. Their LLPs didn't just give them hundreds of thousands of dollars so they can hold their money and pay them a dividend for 30 years. They're giving them a few $100,000 so they can go buy a collection of businesses, scale it, right? Get in any way that they can build out efficiencies, cross-sell some things, build up profit, build up revenue, package all that together, and then go sell that within 5 to 7 years to another private equity firm that is focused on larger companies. And the days we don't see as much companies being taken public as much anymore because private equity has become so large. And now, even with the way that private equity is structured and the access for retail investors into alternative investments and private funds, we've seen recently through a lot of the 401k regulation that's come out, has only led to private equity firms becoming larger and providing more private equity that can go into these deals. So firms are staying private much longer, and firms can stay large and private for a significant amount of time. So when we're looking at deals, they're looking at cash flow, and they're looking at cash flow in 5 to 7 years with the expectation of a liquidity event later on. I mean, I was talking to a client yesterday at the same situation, right? They were bought out last year, and before his earnout was done in 2 years, they were already sold again, right, to the other private equity firm that was going to take everything over. Right. So there's a constant revolving door of equity that's there. And depending on how the earnout is structured, which we can talk about here in a little bit, you likely get pitched some of that equity as well. So let me hop back in here.
We got a bunch of questions exploding on the chat. As always.
Perfect. That's what I was going to get. I only see one on here. Oh, they must be on your side. Okay.
No,
all right.
Okay, don't worry about it. Are there any listing firms, i.e. FP Transitions, SRG, et cetera, which specialized or are more educated in flat fee firm transactions?
Yeah, that's a great question. No, I've not seen any. A lot of the situations that I've seen have all been kind of business to business transactions where somebody sells their client book to another advisor or transfers clients over, or ends up doing kind of an acqui-hire scenario where somebody takes their clients with them and joins another firm. And it's been very different. I know, talked to many of those firms in the past, just in networking type events, that it becomes very difficult for them to come up with benchmarks. And a lot of times, because flat fee hourly firms tend to be smaller, a lot of private equity and larger buyers aren't really too interested until you start hitting revenue of 2 to 4 million. Right? where it makes it kind of worth it to throw into the portfolio, or else they'd have to aggregate so many, right? So it doesn't make a lot of sense there. So there's not a lot of benchmarks.
Wouldn't a flat fee firm also have a source of revenue similar to that of AUM, because the new owner is taking assets and a stream of income, while hourly advice, there's no existing stream of income?
Absolutely. Yeah, I think that's absolutely true in the sense of if a flat fee firm is managing assets and you have money coming in, or if you have a retainer that you're charging on a monthly basis, that definitely creates more recurring revenue, which does lower the risk to a buyer. What you have to be careful about is making sure that that recurring revenue that a buyer is buying is not based on you as the advisor. That's the risk, because then what are they going to do when you leave? Right, that becomes a bigger concern.
Okay, there's another one. Aubrey, I'm gonna hold your question until the end because it's a little broader, okay, bro? Yeah. Okay, so just carrying question, how much per hour should I benchmark against to be profitable and sellable as a business? I have an annual flat fee of 4,500 to 9,900 a year, but because there is so much service I provide, some clients are only essentially paying me $100 an hour. Not good enough to hire support to scale.
Yeah, I don't think there's a wrong answer to that question. I just think it depends on matching your hourly rate to the services you're providing. Right. I mean, there are firms charging hundreds of dollars an hour, and there's firms charging under $100 an hour. And it really depends on matching the type of client you're looking at, right? If you're dealing with a client that has an income of, let's say, $50,000-$60,000, you can't go charge $500 an hour. That's going to be really difficult for them to be able to afford any of the services that you're offering. And frankly, there'd be plenty of other services that are available to them at a lower hourly rate, right? And same with flat fees and projects. I mean, we'll charge tens of thousands of dollars for a plan in many cases, right? And depending on what you're covering, that can make a lot of sense to clients, right? Where that absolutely wouldn't make sense to others.
Next question. Great overviews. I agree. What do you consider assets under advisement, and how do you logistically handle these clients?
So assets under advisement, the way we measure it, and there's no official definition from the SEC on covering that, because so if anything, it just shows kind of what plans we're working on throughout a year and how many assets we advised on is how we aggregate it throughout the year. So it changes annually. When we're handling clients, it's a team effort, right? I'd never be able to do the stuff that we're doing now with just me. Right? We have a team that everyone's specialized in very different things, right? Even down to operations and marketing, and the advising team is all set up with different expertise. So it definitely becomes more of a team effort there for sure. And it's required. I mean, at that, with what we're charging, it can't be just one person there.
When we look at multiples, do we subtract our quote comp end quote from the net, which is used for the multiple?
Yeah, so that I assume I'm going to make an assumption, and Paul, correct me if I'm wrong on your assumption, or in my assumption. I assume you're talking about your personal compensation as an owner and how that comes off of revenue. Perfect. Yeah, that's a huge one. Where you're jumping like 2 slides ahead of me. So that's good. From a professor standpoint, if you keep getting questions for the next slide, that's a fantastic sign, right? That we're moving in the right direction. So I could definitely jump into that one, because the short answer to your question is absolutely yes, right? That you have to be able to subtract out your compensation, and that is a commonly debated number right there, especially in consulting business, because what you'll hear is let's say somebody's making $400,000 in profit in the business, and they're paying themselves $50,000. And the buyer comes in and says, well, that's not fair, right? You probably need to be earning $200,000 in that case. And now you have to cut your profit from 400 down to 250. And what's funny with dealing with clients where you normally have that dichotomy, right? And one side, they're like, there's no way I'd have to pay myself 200. Then another conversation, you ask them about buying it and they'll say stuff like, no one could ever run the firm the way I run it. It would be so hard to hire for somebody, right? And that has to be matched, right? So that is one of the main points of contention that come up, is not only what is a realistic compensation for you, but also what's a realistic compensation for a team if you're running multiple jobs, right? So you may be willing to work 80 hours a week and get paid, $150,000, but for someone buying you, they may need 3 positions to do that. And now you're stacking up benefits and all these other things on top of it that would go well above 150 or $200,000.
And the chat continues to explode. Come on, everybody, just fire those questions away in the chat. Woohoo, this is great. This is why I love the transparency community. And by the way, if you haven't registered for the immersion yet, the link is in the message field on the Zoom, okay? So are you providing family office services and using that model with all of your internal specialists?
Yes, we do for some clients. Yep. It depends on what model they're looking for. And then down their client real estate holdings in their assets under advisement, not personal real estate, it would only be invested assets of real estate. All right, I'm going to jump back in here for a few slides and I'll hop back out. So when we talked about AUM firms, flat fee hourly firms, from what we've seen, tend to match more of consulting type firms and service firms, which means you can pretty much take recurring revenue at around 1.5 to 2.5 times revenue would be normal. Now, I'm going to throw a big asterisk on that and say that depends very much on what is considered recurring and how sticky that revenue is, right? So you may have a recurring monthly fee or an annual fee, but then as a buyer, someone's going to be concerned with, if you leave, how much of that truly is sticky, right? And whether or not. So generally, and this is something we'll talk about a little, to reduce that risk, the owner of the firm typically hangs around for a year or two in the buying firm, generally salaried, as more of a consultant role and transition role of making sure their clients still have a face that they know and is there to help the transition from one firm to another. So hourly building, and I think somebody had already kind of brought this up a little earlier. Flat fee recurring is going to have a higher multiple than just pure hourly billing. But again, that's not uncommon. I think sometimes we look at this and say, oh, this is such a unique model, and it is in finance. But this is how law firms are set up, right? Law firms are hourly billing firms. They start the year at 0, just like any other hourly firm, and they build them up throughout the year. So there is more or a lack of predictability there, which leads to a lower number. And then you also have any discounts that'll come from retention risk or key person risk. So we have those. Whenever we get into EBITDA multiples, so you'll typically see 3 options. You'll see a revenue multiple, which will get used. The danger about a revenue multiple is, what if I'm running a business that has a ton of revenue, but I'm horrible at managing it? So I'm like losing money every single year. So revenue multiples are typically more useful when a company is growing at a fast rate, because you'd expect that their profit is being reinvested back into the company. So revenue multiples are more realistic than a EBITDA multiple or a profit multiple, because profit multiple assumes there's profit there, or that profit is a realistic expectation. This is very similar to kind of the Amazon model. Whenever Amazon was kind of taking losses every single year, you can have a stock that has losses every single year because it's growing revenue. It just may be plowing back all those earnings back into the company. So EBITDA multiples, typically 3 to 5 times EBITDA. This goes exactly into Paul's question about compensation, right? And that EBITDA multiple needs to include, right, true compensation for you as an owner and any other true expenses. Now, the other thing is, if some expenses happen to show up on your business, some personal expenses happen to show up on some of your business financial statements, right, which I know no one here has ever seen happen, right, then that would also have to be cleaned up as well, right? So you'd have to have owner adjusted statements to reflect the fact of, and that's typically what happens. You'll have your books, And then the buyer will come in their due diligence period, look at those books and say, all right, now I'm going to add a higher salary and I'm going to subtract out any of these expenses that I don't think are realistic for the business or needed for the business. And that gives me a clean EBITDA number. And then with that clean EBITDA number, then I can base that on a multiple. And maybe depending on how much I trust that EBITDA number or how little risk there is where I'm going to fluctuate between 2 to 6 times or whatever it's going to be. And this is why keeping clean operations, especially early, is so important. The number of times I've met with somebody who says, I'm ready to sell, I want to retire, I'm burnt out, and they try to sell. It's so unfortunate because the business could be clean, but the books are a disaster. And when we're talking about risk, a buyer comes in, and even if you like, I mean, I'll give you a great example of this. I've got a client who owns a relatively large trucking company, right? And they run everything. It's him and a partner. They both have their own credit cards, right? That are both their personal expenses and the business expenses. And this is the most honest guy you'll ever meet, right? He's not trying to do anything fishy, nothing shady going on with any of the statements, but he goes and reimburses himself, and his partner reimburses himself out of the business account, right? For any of the business expenses on their personal card. The finances are a complete disaster when you look at all of this, right? Because there's so much moving of money back from him to his partner, from his partner to the business and all of this, that when he goes to sell, that is going to send up so many red flags, so many unnecessary red flags, that he's going to end up having to take a really low multiple if he can get any offers at all. Right? Because if I'm a buyer looking to buy a trucking business and I sit down and say, all right, show me the books, and the books have to come with, here are the books, but let me explain some things first. That immediately sets off red flags. I'm starting to get nervous about what's going on here. Right? Of like, what do you mean? Like, explain the whole process. Like your wife's on this card and you're on this card and your partner reimburses on Tuesday and you reimburse on Friday. Right? It's worked and it works for them. But that was one of the big things. Like, if you want to sell this business, you're going to need at least 2 to 3 years worth of clean records that a buyer can look at and say, let me see whether or not this business actually has been as profitable as expected or as consistent as expected and is clean. All right. So it becomes really important to keep that level of clarity, both in the record keeping and in expenses. And those margins, especially in service businesses, tend to have higher margins. You don't have as much of the overhead. So you would shoot for that 30%, 30% margin after paying yourself a reasonable compensation. Now, those multiples, you're going to drop down to this 2 and 3 times multiple the more dependent your business is on you, right? Or have more risk when it comes to uneven cash flows. Again, the goal is to sell a business, not to sell a job. You're always going to get higher multiples from synergistic type businesses. That's why Disney buys Marvel and Star Wars, right? Synergistic businesses tend to have the highest multiple that you're going to get because that business sees that there's added value that no other business is going to get. So they're willing to pay a little bit more than any other business. Procter & Gamble trying to buy the Star Wars franchise doesn't make any sense, right? Disney buying the Star Wars franchise makes a lot more sense. So if Procter & Gamble and Disney are both competing to buy Star Wars, Disney's going to be able to put in a much larger offer. So Star Wars is going to be acquired at a higher multiple. And we see this happen all the time with synergistic deals. Now, the last one, and then we'll hop out here for some questions, is going to be a discounted cash flow analysis based on forward-looking projections. So it's a little bit more financial, which fortunately all of you be familiar with. It's discounting cash flows back. You're projecting, what do you think this business does in the next 3 to 5 years? What's your free cash flow on that? And then discounting those free cash flows back to today to get a value of what that process or what that business is going to be worth. So the benefit here is you're allowed to put it, you can easily put in growth rates. The challenge is that it does end up requiring some credible assumptions. It's a model, so it's a garbage in, garbage out scenario. In fact, I have this one. It's a screenshot, but let me pull up. I'm just going to show you what the actual model is here. Can you all see that one? All right. Make sure I don't mess up any of the screens here. Share that one. So here's a really easy DCF analysis, right? So we have revenue at $1 million, right? Maybe you've got 43% margin, which would be high, right? But we'll say it's 43% margin. and you have some depreciation, some taxes that are paid, assumption is a C Corp. Right? We run some capital expenditures through here that are expected out in the future to reflect that things would have to be updated, or you have to buy some computers, you have to buy some things, whatever it'll be. And then any change in net working capital, right? The fact that you expect the business to get larger, which means a requirement of more net working capital in the business, or more current assets that have to be reflected. So then you have your unlevered free cash flow. You have some sort of terminal value to represent all cash flows growing in perpetuity at a terminal growth rate of, let's say, inflation or GDP, say 3%. And then you discount everything back to today. So you get your sum of all the discounted cash flows at 2 million. You subtract out your debt, add back your cash, and that gives you your intrinsic value. Right. So DCF analysis is the most common type of business valuation that you have, whether it's investment banking, investment bank for public companies, private companies, small companies, large companies. It can be used for everything. It's very versatile. And you throw things like, well, if you expect that the business is going to grow along right around 5%, right? Well, now your implied PE ratio is lower, around 3.8, right? Your intrinsic value is around 1.6. But if you're going to grow at 15%, now your intrinsic value jumps up to about 2.3 million, and implied PE is 5. So you immediately see that growth rate matters quite a bit. Now, it's not to say that you can just say whatever growth rate. I can't go in and say, I think I'm going to grow at 30% a year, and valuation goes up to 8 times multiple, right? Because what they're going to do, I can say that all I want, right? So you can say that all you want. All that's going to happen is the structure of the deal. And that's what throws some people off to when we look at this, is they run all these spreadsheets and say, I know how much my business is worth. It's worth $3.5 million. And you say, well, that's great. And they say, well, I can't wait to get my check for $3.5 million. I wonder how much am I going to pay in taxes and all that. The reality is you are not getting a check for $3.5 million. That is not how this is going to work, right? A buyer is going to come in, maybe write your check for $1 million, maybe $500,000. And then you're going to have an earnout where over the next few years, you prove that you're going to hit that 30% growth rate. And then we'll pay you the other $1 million. Or we'll pay you another 750,000. Maybe we'll be willing to pay you 5 million, right? As long as you meet 40% growth rate, right? We can throw some other carrots and incentives in there, right? That's how these deals are structured. The value is only one piece of the puzzle, but when it comes to deal structure, that's when it really gets to be kind of a fun area of where this all can come into play. And so I'm gonna hop out here and check in with Sarah here for more questions, and then I can hop back in.
Yeah, there sure are more questions. Excuse me. Does the EBITDA multiple only apply to AUM flat fee, or can it also be used to value hourly advice only firms?
Oh, absolutely. Yeah, any of them. I mean, the EBITDA multiple could be used for any firm. I've seen it used from everything from sports television rights to major publicly traded companies. It doesn't matter, because you're just focused on the cash flows that are received. The issue would be the discount rate. So with an hourly firm, you would likely have more risk that those revenues are recurring. So you would have a higher discount rate. So in that model, I was using a 20% discount. You might have a 30 or 40% discount rate used on those cash flows.
Next question. This is very validating since I support several individuals setting up private practices. Is there an established path to selling an hourly flat fee business to a junior advisor who wants to grow and take over the business?
Yeah, there are. I'd say that kind of goes into that idea that the structure could be very varied. What you're looking at. The issue with junior advisors taking over tends to be the cash flow ability of them to purchase the firm. So you end up having to sell at a much lower multiple or a much longer time horizon. So it's not that it can't be done, but you can't go to a junior advisor and say, I want to sell my business for $2 million, right? And I want to sell it over the next 2 years. They just don't have the cash flow to be able to do it. So you see this in physician practices pretty often. And even then you'll have usually like a 10-year buyout where every year you're buying in with some of your salary, 10% of the firm. And that means every year you're getting a 10% more of a dividend, right? And then at the end of time, at the end of those 10 years, you've now fully bought into the practice and the selling physician is fully sold.
Next question. Is average age of clientele a key factor in potential growth?
Love it. Yep, that's coming up. I want to see if this is
Okay.
the next one on here. Yeah, let me hop back in here because this is a good one, right? On this one. Absolutely, it's a key factor because as much as we maybe want or not want to talk about that with clients, right? The older your clients are, the less revenue retention there could possibly be. Right. So if we look at these, right, if we're looking at core drivers for these, then client retention becomes big. I think we've hit that one quite a bit, right? In the sense that we have to be able to retain these clients. We have to make sure that revenue is retained as much as possible. So we're looking at how much churn there is, whether clients are coming back, whether or not they're coming back regularly. And then you start looking at these, right? Profitability and efficiency. Operations matter. Businesses that are run by systems and not people tend to work better, right? Especially when that people term is the owner, right? So we want to make sure that we're keeping clean records. We are looking at efficient operations. We want to make sure that all the T's are crossed and I's are dotted as we go through here. So that way we have everything set up, right? We want to reduce that risk as much as possible. And this one comes up for smaller businesses. Owner's comp is always a point of contention, right? Because somebody working 50, 60 hours a week is not likely being compensated fairly from their business, which means all of their profit multiples are likely incorrect. Right. Now this hits exactly where we were. So this time we're only 3 slides off. All right. Younger client base, more future revenue. So if you have something that can drive lead generation, this is another one. Saying that referrals is your answer for lead generation is a dangerous term for someone looking to buy a firm, right? Because they're looking to buy a firm that's scalable, right? They want to have something that can scale up, and referrals can be great. But referrals are not a scalable process. It's difficult to make referrals exponential, especially in finance where we're restricted to what type of referral incentives we can provide. And so that's always a tough one. Obviously, you're in a certain niche. That's always helpful to have some sort of positioning there because you likely have some sort of cleaner lead generation process for you to drive new clients. And the last one's always good. And this goes into the story perspective, right? When you're going into sell, it's not only a valuation perspective. You have to be able to tell the story, right? You have to say why someone should want to buy your firm. And you have to leave enough meat on the bone. You can't say, my firm's great. I've taken all the opportunities to grow this firm and I've maxed them all out. Right. And I've done fantastic. It's an efficient process. Because why is that interesting to me? Right. You're telling me there's no more meat on the bone. I'm just buying a firm that's going to do the same thing it's always done, which means there's no upside. There's only downside to me. So the story needs to be that here's my firm. It's run really efficiently. And here are all the possible paths that you could take this to continue growing. And you end up setting up that strategic relationship. So that way they're looking at it and saying, that does make sense for us. And hopefully a good buyer will already have those things in mind, right? Because they're talking to you for a reason. So documenting that growth plan also helps to reduce risk and makes everything cleaner for a buyer as well. And this goes into that exact structure or topic we were talking about, who's going to buy your firm. Right? Typically, you go 2 directions, obviously, internal or external, or you just shut the door down. And I think closing the door is probably just shutting down one day is probably one of the worst things that collectively we could do for flat fee and hourly firms, right? Right up there with just handing clients over to another advisor. That's always a tough one for me to see, right? Because it devalues a lot of the work, right, that goes into these businesses. Somebody builds up a business and has a great client base and they just stop serving the clients or they hand them over to another advisor. Well, what does that say to somebody who's considering being an hourly or flat fee advisor? Right. That says, the business that you work so hard on, right, actually doesn't have much terminal value at the end. And I think that's a major disservice there. But internal, we had talked a little bit about that. External, and we've talked a little bit about these too. Different RIAs, aggregators, PE firms, right? They all are wanting scalability. They want retention, right? Internal, you have a little bit more flexibility on that, right? They may be wanting a job, right? They want to be the boss, right? So they want to move up into that role. So you have a little bit of flexibility there, but it's going to be a lot slower. And there's going to be a lot more risk. You're now dealing with an unsophisticated party, right? And that's the problem with any transaction. That's not necessarily a knock on any junior advisors or staff or other advisors in the firm, but there's definitely a difference of selling to like if you had one of these PE firms or RIAs or anything else that has gone down this before, versus the uncertainty of internal selling to a junior advisor who may back out at the last minute. Right. And we've all heard those horror stories of you have someone who's worked for you for a long time, and the plan is they're going to take over the business one day. And then one day they come in and say, you know, I don't want to do this anymore, or I'm going to go work for a different firm, or I'm going to go open up my own place. Right. And now your succession plan just walks out the door. So huge risk to start having that plan in place early. The deal structure side of things, right? And Don is on it, right? Your question came in right around the earnout discussion here, right? So for flat fee firms, when it doesn't very change too much in the sense that earnouts are always funny in that usually it's a year or two. Right? Very rarely would anyone want to go out past 2 to 3 years of a business they no longer own, right? And because the buyer can just run it into the ground. So you don't want to usually go out past a year or two for an earnout to make sure everything's there. I've seen some smaller businesses go much closer, maybe 3 months or 6 months, just to confirm that everything's okay in the business. But that earnout is generally tied to retention of clients. So you retain most of your clients and revenue stays flat for the year, grows a little bit, and we'll give you your next earnout check. And there's no rule on how much needs to be received up front versus at the end. How it's usually reflected is just a change in the multiple, right? If a buyer comes in and you want a big check up front, they may be willing to write you a big check up front, but the overall multiple for the sale of the business will be less. And because now you're increasing their risk and decreasing yours. On the other hand, if you say, well, I want to put more money on the back end, that's reducing their risk, right? Which means you could probably negotiate for a higher multiple in those cases. So that's the fun part about a lot of these deals. There's no real deal that everyone sticks to. It really does depend on the structure of the person selling and what their goals are. I mean, and internally we've done deals like this in these types of situations where we either have somebody wanting to avoid the business side of finance and just work with their clients, right? And have a lot of our team do a lot of the back end stuff. That's a very different type of deal structure than other times when we've had somebody who wants to retire and they want to go hang out at the beach house now, right? And they don't want to be dealing with audits or the marketing stuff or anything that comes up with the business ownership side. So they're looking for a faster exit. And that deal looks a lot different. It's hard to put an earnout on somebody who doesn't want to be involved in the business within 6 months, right? And it's a lot easier for an earnout when somebody says, no, I'm looking at this as a career shift and a complete change in the direction of my career. And some case examples. This is we actually kind of did this already, but let's assume you have a single owner, team of 5, $720,000 a year of recurring revenue. Maybe they're making $180,000 in profit. We'll assume a 25% margin, right? So roughly at $1 million in value on a revenue multiple. Retention, stronger margins. Maybe they're at 1.3 million. 4 times EBITDA would put them around 720. So what's interesting is when you start running all these multiples, and if I threw a DCF on here, I bet I'd get an actual pretty similar situation where the value of this firm is probably somewhere between 700 and $1 million. Right. So it's not as big of a dispersion as some people think when they're looking at valuation. What changes is exactly what we're talking about. It's on deal structure. Right. So this exact structure of having $700,000 or so may reflect $300,000 received in cash, $200,000 over the next 2 years. And maybe it's a PE firm buying them out and they want to put $200,000 of your earnings into the PE fund so that you can participate in any upside afterwards. And you get a salary for the next 2 years through the earnout. And the hope is that in year 2, you're really not doing much, right? I mean, that's always the funny thing. And I know you have likely seen that with clients who have gone through some sort of liquidity event or acquisition where it's like year 2 of that earnout and they're just hanging around the office, right? They show up because they're contractually obligated, but no one has talked to them in like months. right? They just have an office somewhere because they're required to be there as part of the earnout. But if the company buying them has done their job, then the need for the owner has decreased over time. The original owner has decreased over time. So on the last thing here, before getting into some of the key takeaways, and we'll open it up for questions, because I think I'll have some should have some time here for questions as well. Tracking metrics, publishing all your retention metrics, being very transparent, very clean. Dashboards are great for this. Having a transition plan and starting to plan early, right? This is not something you want to do the day you want to retire. You want to start building these relationships and networks. So that way, the day you do want to retire, want to sell, you already have a list of people you can call and say, hey, I'm interested in selling. Right. And what does that look like? So, and those are the key takeaways there, right? Multiples are going to hinge on risk, right? It's retention, it's scalability, key person risk. Anything you can do to reduce risk is going and reduce risk and increase transparency is going to lead to higher multiples. That's really what it's going to come down to. And since we're coming up at the end here, right? By all means, feel free to contact me. You can reach me directly at Stefan at Scholar Financial Advising. If you ever want to talk about it, I'd be remiss to say that if anyone knows anyone looking for a job at a firm or any of these transitions, definitely let us know. Jump on the careers page there. We've got a few positions that are open, and always interested in talking to people who are interested in either joining the firm with themselves or retiring, anything like that. So I'll end it there, and then I'll hop in for questions. So I'm sure there's some more that I missed.
There's a ton of questions here in the chat.
All right.
So Stephen Fox, Stephen, are you here?
Hi, yes.
Hi. Stephen Fox did an internal buyout. All right. And Stephen, would you mind just talking, because people are asking, people are in the chat are asking,
That's a great structure.
do you have examples of business transfers that have resulted in a great experience and benefits for people? Aaron, you asked another question about this, like doing an internal buyout. Okay, so this is going to cover a few of the questions in the chat. Please continue to answer your questions into the chat, folks.
Yeah, we don't have enough time for me to go into as much detail. I think you probably recorded that presentation that I gave in Immersion earlier this year. I'm totally fine with you sharing that out if you want to, or anybody wants to reach out to me, I can answer more. But yeah, I just kind of wanted to make a note there briefly about the point that was made about for internal sales to junior advisors, you often have to take a big hit on the value or do seller financing. And I just put that note because I wanted to give people some reassurance that that's not necessarily going to be a barrier. It is still totally possible without taking a huge hit on the value, as long as you stretch it out over a longer term and don't require them to provide as much upfront capital. It can be done. So don't think that just because it's a flat fee firm or a small firm of just a few advisors that this isn't available to you.
Yeah, definitely. If you don't mind me asking, would you stretch that over like 5-6 years or so?
It was 8 years, and we did 100%
Okay,
financing. Yeah. Another advantage is I also
so
treated it as an installment sale for tax purposes, so it helped on that front. And then they're paying interest along the way as well. And I see Joe's question. Yeah, it's equal payments. So it's just a promissory note for the total purchase price with a 10% interest rate applied equally over an 8-year term. And so they have a standardized monthly payment amount. They can make extra payments anytime they want to. If they want to pay it down faster, they can refinance anytime they want to.
Great information. January 2025 SRG average multiples are 3.1 times revenue and 7 times normalized EBITDA. Are flat fee multiples significantly lower?
yes, yeah, yep. They are, because SRG is probably using, and they will be using AUM valuations, right? So transition's a lot harder there. And those sales are going to be larger sales as well. The smaller the sale, the higher or the lower the multiple is going to be. So bigger the sale, higher the multiple. That's why, I mean, you can have a publicly traded company trade at a multiple of 15 or 20.
Okay, Don, hold on. Everybody, if you could just hold on for a minute. I'm going to put Stephen Fox's presentation from Immersion 2026 into the chat. But I first have to just launch a few more questions here to give me the respite to be able to do that. Okay, so another question in the chat was, is it fair to say that most older advisor, older client, small firms don't have any value beyond gaining a client list that may have some referral potential?
Yeah, I think there's value there. I mean, the way we've seen that internally, the value is generally the human capital side, right? Now, if you're saying, so we have older clients, small firms, older buyers. I think there's still value there. There's still cash flows. You just may have a smaller multiple, right, associated with it. There's still, I mean, we're looking at DCF now. It's only 3 to 5 years, right? So you just probably wouldn't have much of a terminal growth rate on cash flows. So I think there's still value there for sure. There would be a discount to reflect that.
So the next question is, zooming out, there are multiple forms of value built into practice. This seems focused on financial valuation and transfer, which is important. How do we transfer other forms of value to the buyer and also to the larger community of planners, advisors, and the people and organizations we help? Other types of value processes, tool integration, relational, community, identity, role, approaches, brand, story, mission.
Yeah, that's all goodwill, right? I mean, that should all be reflected. So I could give you the pure finance textbook answer and say that should all be reflected in your profit and revenue, right? If all of those things are fantastic, then you should have a higher profits and higher revenue because this business is successful. That should be the case in any successful firm. Right now, if you have some really specialized processes or you have a special lead generation process that no one has or hasn't used, then that's absolutely valuable. It would be reflected in a higher multiple. And I see one from Aubrey in here too. It seems like clients get screwed in most of these sales. I may be wrong, be glad to be wrong. Are there best practices to screw over clients less? I don't think that's true. That I think it depends on who the buyer is and what it is. I think a lot of times when you sell out to some of these large aggregators, that's more likely. But there's a lot of examples. I mean, we've done this successfully multiple times where we've had advisors who have come on and have put together deals for clients where the advisor is still advising their same clients, and it's a much slower transition, right? And I think that's probably from a best practice perspective to screw over your clients less. It's not to sell your book of clients and then leave the next day, right? It's to be there through that transition period.
Do you anticipate the multiples increasing with the proliferation of this fee model over time?
Depends. If we it has to be a kind of a concerted effort, right? In the sense that if in, like, for instance, Paul, you're asking this, right? It's like one of these things that it is, but if let's say, like Steven's example is a perfect example. If Steven just gave away his business and didn't have a structure in place, then that hurts it, right? Then multiples would probably go down because then the norm is that a business is free, right? So I think the more times that we see businesses like ours transact and move around, that's better for multiples because buyers become less risky because there's comparisons out there. So I think it could, right, go up, and it likely will, but it's still going to be capped by normal industry multiples around non-recurring revenue, right? So the most you can do to show that your revenue is recurring, I think the better on that. So, and I know I'm kind of dancing around that question, right? On the sense of the way I would look at it is your firm can increase your multiple much faster than waiting for the entire industry's multiple to go up, right? And that would be the opportunity I'd look at. Any others?
I have a question for everybody on this meetup. What do you think was the most interesting thing that you learned during this meetup today? I'm going to tell you what it was for me. I've never really been able to justify somebody thinking about this throughout the span of the life cycle of their business. I always and I'm wrong, I stand corrected, honestly, that it would be something you would think of more once you get off the ground, once you get established, once you even get closer to retirement. But now hearing this, I think to myself, the whole way the practice is set up impacts what the end looks like. Because I could just imagine the mishmash that you would have to wade through if you set this up incorrectly and then decided midstream to prepare it for a sale.
Yeah, I can't stress that enough. And that's not just a finance or flat fee scenario or anything else, right? That is all the way from the beginning, right? Of in any type of business, service, manufacturing, finance, consulting, healthcare. It's the same setup because you think about how you structure the business much differently whenever you are expecting it to have a value beyond a job.
Okay. All right, everybody, I'm going to end the meetup in 10 seconds if nobody has any more questions.
Hey, Sarah, I just want to add, and I put it in the comments, to both Stephen being here and Stephen Fox and you sharing those informations. What was the most beneficial of today's call? The transparency. This information needs to be shared. People need to understand it. And I so appreciate you bringing spokespeople like this together so that people early on in their careers can see how important this is. That's the takeaway. I really appreciate you guys speaking about it.
We appreciate you too, Eileen. Thank you. We appreciate everybody. This is the value of community. And I don't mean to be like pushing this agenda here, but I really do believe that our best asset is each other. I really do believe that because there's a lot of humility in this group. There's a lot of generosity, clarity, logic, and not everybody in the industry thinks this way. Not everybody in the industry thinks this way, okay? So we have to sharpen each other's minds. And I really think that we can change the world if we just help each other. And that's why I do these things. All right, so please show up to the meetups, participate in our transparency postings on social media, in our chats, read the newsletter, come to the immersion. All right, if anybody has financial difficulties and cannot afford the immersion, please let me know. If anybody needs marketing support and wants to work with me in one of my programs that I put in the chat originally in the beginning, please let me know. I'm not here to make a gazillion dollars, off of this program here. I'm doing this to serve you. I've created this for you, okay, for all of you. I don't want cost to be an obstacle in anything that we do in the transparency movement because I want the virtue to be able to triumph. And I'm willing to sacrifice to support that, okay? Amen. Thank you, everybody. I will see you in October, and please continue to be transparent. Woohoo! Thank you, Stefan.
Thanks for having me.
Bye.